of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to yet another episode of Business Standards Banking Show. I am Ruchika Chitravanshi. In today's episode, we will talk about the SVB bank collapse and Fed's balancing act between the inflation target and financial stability. Ramesh Narasimhan, CEO of Worldline India, spoke with us in our Banker's Take segment. We will decode for you how deposit insurance works in our Banking for You segment. Our consulting editor, Tamal Bandhopadhyay, joins us to talk about the lesson for India from the Silicon Valley Bank collapse. At the end of the show, we will tell you the poll results and the question for this week. Stay tuned. Financial markets globally have been jolted by the collapse of the Silicon Valley Bank, followed by more cases of bank failure in the world's largest economy. The US government and the Fed have swiftly stepped in with regulatory support. Experts, however, have flagged the moral hazard involved with the steps taken, especially as the bank failures have had much to do with inadequate risk management. Bhaskar Datta digs deeper into the implications of Fed's actions.
The Federal Reserve's protracted efforts to tame alarmingly high inflation in the US had barely started to yield results when weaker links in the country's banking sector started to snap. 3 US banks, Silvergate Bank, Silicon Valley Bank, and the Signature Bank went belly up in a matter of days in early March, while the government coaxed larger banks to take over the First Republic Bank and prevent it from capsizing. The US Treasury and the Federal Reserve have acted quickly to prevent panic, with the government seizing some banks and guaranteeing depositors' savings. Subsequently, the Fed opened a liquidity window for banks to prevent funding channels from freezing. Some experts differ, however. They argue that these actions will make banks continue to take risky bets, secure in the knowledge that the Fed will protect depositors, like in the case of SVB, where bond and equity investors suffered losses, but the Fed saved all depositors, even the uninsured ones. Essentially, the SVB crisis resulted from interest rate risk that stemmed from the Fed's rate hikes. The rapid increase in policy rates eroded the value of SVB's extensive bond holdings. Then, large-scale withdrawals were the final nail in SVB's coffin. Experts point to glaring gaps in SVB's management of interest rate risk. Some have already referred to the Fed's liquidity window as a fresh form of quantitative easing that runs counter to inflation management. A softening of the Fed's approach to inflation implies financial market dominance over policy, possibly at the cost of macroeconomic goals such as inflation management.
My understanding is that in any kind of bailout or support, there is an element of moral hazard involved, because the bailout is invariably in response to some kind of stress that has been brought about by not adhering strictly to regulatory norms or because of poor governance standards. In the specific case of SVB, we know that they didn't have a chief risk officer, for instance, for a year or so. So there is an element of moral hazard involved in any kind of government support to a stressed entity, because it just encourages other entities to take on that kind of stress. If the markets and financial entities are really driving Fed decisions and kind of arm twisting in a sort of a perverse sense, them to abandon some of their core macro targets or agenda, then there is another moral hazard.
Analysts did say, however, that so far the current episode is not an international contagion like the global financial crisis of 2008, and the official response is unlikely to flood markets with cheap liquidity and reverse the fight against inflation.
The current dynamics that you are looking at are not very similar to what we saw in 2008, where it was a banking crisis altogether, and we actually saw a systemic failure, which led to the policymakers sort of getting into a full-fledged, policy support mode. I think currently we have to consider two factors, especially the fact that the US economy is growing more than 2.5%, 3% so far this year, and global growth is also around 3%. Despite the kind of rate hikes that we saw in the last 1 year, which have not been able to engineer a very sharp slowdown as yet. And the playbook for resolution of failing financial institutions like Credit Suisse is already well developed now. Both of these factors stand in contrast to 2008, and hence I think the probability of a negative feedback loop is looking to be low.
Comparisons to the global financial crisis notwithstanding, the latest bailouts raise questions about lapses in risk management and banks considering themselves too big to be allowed to fail.
Bhaskar Datta raising some pertinent questions there. In our next segment, Ramesh Narasimhan, CEO of Worldline India, a payments aggregator, tells us why there is so much interest from various entities in this business.
Hello and welcome to the Business Standard Banking Show. Worldline India has been authorized by the Reserve Bank of India to continue to operate as a payment aggregator along with 32 other entities. Payment aggregators are those who enable e-commerce sites and merchants to accept various payment instruments from the customers to complete their payment obligations. Ramesh Narasimhan, CEO of Worldline India, is with us today to talk about the payment aggregator business and the India's growing digital payments ecosystem. Mr. Narasimhan, welcome to the show.
Thank you, Manojit. Pleasure to be here and looking forward to our discussion.
So, what positives will a payment aggregator's license from the regulator will bring to your business?
So I look at it in two perspectives. The first one is, at the end of the day, we are handling public money, right? And public money needs to be safe. So when you see the regulator coming up with regulations, or the government insisting on regulations in improving the regulations to ensure that public money is safe, we all feel reassured as ourselves because we use the same payment methods that are available to all our end customers, right? So we want to be assured that our money is safe. So first is to ensure that the payment industry is healthy, that there is a formal framework set up by the regulator, and there are aspects of guidelines that are to be followed to ensure that the right kind of players are there in the payment industry, right? Now, if you see the kind of things that the license demands, which is the capital, whether it's 15 crores or 25 crores, depending upon you've been in business or you just started, right? To the various other parts that has been specified, whether it be in terms of onboarding merchants, whether it be in terms of KYC, it all goes to protect the interest of the public at large who are using these payment methods to make payments, right? And avail of services and goods. So I think it's very critical that these have to be in place. And as I see it, it also means that at the end of the day, as a customer, as an end user, if the common citizens in India feel safe doing digital payment transactions, then I think you're absolutely in the right place. And so what it does essentially is to ensure that the right kind of companies are given licenses, that they have the right infrastructure, they have the right technology, they have the right people, they have the right processes to ensure that when you handle public money, you're doing it the right way. So I think it's good for everyone around, for the payment aggregators, it's good for the regulators, it's good for the Indian citizen at large.
Digital payment space. Now, digital payments has soared in the last few years, but cash still remains the king. How much more we can do to reduce the dependence of cash?
Yeah. So absolutely, you're right that cash is still the king, and if you see the government's direction also, they want to make us a less cash society, right? It's not a cashless society, it's a less cash society. And if you see all the publicly available data, digital payments have increased by 33% year on year from 21 to 22. Even RBI's digital payment index has risen to 377.46 from 349.3 in March 2022. This is September 2022, right? The regulator also offers something called the Payment Infrastructure Development Fund, which is to incentivize deployment of point of sale machines in tier 3 to tier 6 centers, northeastern states, in helping to grow digital payments in these areas. And of course, the UPI juggernaut rolls on with newer innovation. We're looking at, we now have a solution to even having just a feature phone and not a smartphone to do UPI payments.
Right.
So I think, you have phenomenal support from the government, from the regulator, to be able to offer some of these new, solutions to the Indian citizens at large. And I'm sure it will continue to grow, Manoj. Eventually people will realize, I mean, today, at least in the metro cities, in tier 1, tier 2, maybe even tier 3 cities, most people have, probably don't embrace so much of cash. You can use your phone and pay virtually everything with your phone, and people have, stopped having any money in their wallets. Now, it is not just the convenience of digital payments, it's also about the fact that it means that they have a bank account.
Correct.
Right? Which means if they show a cash flow in their bank account, they're probably, they're eligible to get a loan from a government bank or a private bank at the same rate that you and I get. And they don't have to go to a, usurious money lender who charges them higher rates of interest. So you're driving also, financial inclusion through this, right? It'll take us a few years to get to a point of where we want to be a less cash society. But we will get there for sure, because the simple convenience, the security, which I talked about, when there's a regulator, then you feel safe doing these payments, as opposed to the whole, previous, our way of life of carrying cash with all the other issues that go with cash.
Finally, coming to the issue of UPI, we have seen UPI is one of the most popular digital payment system in India. But there is an issue with whether UPI should be charged. So, do you think UPI should be charged so that the stakeholders feel they have a skin in the game, and therefore they will be more keen to invest and innovation in those space?
So, firstly, let me tell you, UPI is probably one of the best things that have happened to India, right? Absolutely, one of the best things. And I'm not surprised at all when other governments come to us and ask us, this whole India stack. It's something that I'm very proud of. As an Indian, I feel very proud of something which we've done, and done remarkably well. I mean, you have to give credit to the regulator, you give credit to NPCI, you give credit to the government for coming up with something that really works and works so smoothly, easy to use, absolutely all the right things. And I also understand that the government wants to popularize it, the government wants digital payments to grow. And when we went through this phase, when we started using wallets, there were some companies that gave us cashbacks, incentivizing us. I don't expect the government to incentivize us. So the only way the government can do it is to, say we won't charge for this, so that it becomes, more and more the usage increases, and the usage has actually increased exponentially.
Right.
And so our position has always been, along with the Payments Council of India, we're a member there, is that we should be allowed to charge something, so that we, as I said, the logic of charging something to be able to provide services, to citizens at large, we have to be able to monetize it to some extent. And so we always have approached the government through the Payments Council of India, and our position has always been that we should be allowed to monetize. And I'm sure that, so what's happened over a period of time, the government is now offering some subsidy, okay, to the banks at least. So that doesn't come to us as payment aggregators, right? But it goes to the banks. So the government is, I think, listening. Question is, when do they take the call to ensure that we also get a few, small amount of money to be able to provide the service? And I'm frankly very hopeful that and we will continue to represent through the association, which is the Payment Council of India, to be able to monetize UPI and be able to get some money as a result of, because we provide the service. So I think it's important for us that we get paid for providing the service. And our position has always been that we should monetize it.
Right. On that note, it was a pleasure to you, Mr. Narasimhan. Thank you very much for speaking to Business Standard.
Thank you, Manoj. It entirely my pleasure.
Thank you.
While cash still rules, dependence on cash is coming down, and it would take a few more years for India to be a less cash society. What happens to your bank deposit if the bank goes under? Raghu Mohan tells all you need to know about deposit insurance and how it works.
The collapse of the Silicon Valley Bank in the US on March 10th made many people ask, how much money will they get back from their deposits if their bank also collapsed? The answer is up to 5 lakh rupees, irrespective of what you had in your account. Bank deposits in India are covered by the RBI subsidiary, Deposit Insurance and Credit Guarantee Corporation, or the DICGC. So what happens if, heaven forbid, your bank goes under? Under the DICGC Act of 1961, if a bank is quarantined, that is, it cannot lend or take deposits, then the DICGC is empowered to pay deposit insurance on behalf of the bank within 90 days. However, the waiting period to get your deposit sum insured up to 5 lakh rupees can be long. In FY22, the time between a bank's deregistration and the payment of claims was as high as 184 days. This was a massive improvement over FY21, when the time taken was 500 days. In FY22, the DICGC sanctioned claims amounting to 3,455 crore rupees to 2,64,142 depositors of 22 urban cooperative banks. In the case of liquidated banks, claims worth 1,268 crore rupees were settled in FY22. It also helped settle claims worth 3,791 crore rupees related to the erstwhile Punjab and Maharashtra Cooperative Bank, or the PMC Bank. Thus, the DICGC helped settle claims of 8,517 crore rupees in FY22. In comparison, it had settled total claims of only 5,763 crore rupees since its establishment in July 1978 till FY21. The failure of the PMC Bank prompted the DICGC to increase the sum covered under bank deposit insurance. It was increased to up to 5 lakh rupees in February 2020. This increase came after 27 years. The previous increase was done on May 1, 1993, when deposit insurance was increased from 30,000 rupees to 1 lakh rupees. Even then, increase was prompted by the collapse of the Bank of Karad in the securities scam of 1992. But how much do banks pay as premium to insure these deposits? The answer is just 10 paise per 100 rupees insured. The premium rate was last set on April 1, 2005. In FY22 alone, the DICGC collected 19,490 crore rupees as premium. If you have more than one account, then you get coverage of up to 5 lakh rupees of deposit on each account. So, if one account has 1 lakh rupees and the other has 8 lakh rupees in deposits, then both will have coverage of up to 5 lakh rupees only. So, in account 1, your entire deposit of 1 lakh rupees will be insured, while in the other deposits, up to 5 lakh rupees will be insured. The DICGC categorizes banks under 4 groups: functioning banks, those under RBI's quarantine, merged entities, and liquidated banks. Functioning banks and those under quarantine pay premiums regularly. For the merged banks, the acquirer bank maintains the payment discipline. The DICGC Act also provides for membership cancellation in case of non-payment of premiums for 3 consecutive semesters. Overall, the premium collection process is robust with punitive provisions for slips and compliance.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SVB.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So, irrespective of what you have in your account, the maximum you will get back is 5 lakh rupees. The turmoil in the global banking sector has some lessons for India as well, as our consulting editor Tamal Bandhopadhyay explains in this next segment. Hi Tamal, welcome to the Banking Show. Last time, towards the end of our discussion, we talked about the SVB bank collapse and the lessons from the incident. But ever since, we have seen more banks have gotten into trouble. There have been more rescue acts, whether it is the Credit Suisse being taken over by by the UBS or the Signature Bank collapse. Do you still think we have no reason to worry? How concerned are you?
No, I'm not concerned at all. I'm sticking my neck out. The reasons for which all these collapses in the Rescue Act, the 3 names that you have given, very different from the Indian context. Look at SVB. It was a bank for the techies, the tech startups. And the problem, of course, did not emanate from the tech startups. It actually problem was the asset liability mismatch in terms of interest rate, not in terms of tenure mismatch. What happened? It was flooded with money, and that money they did invest in US bonds, and then as the interest rate rose, the bond yield also rose, and then eaten away the value of the bonds. And when this tech guys, the investors were not pretty excited about putting in more money. They wanted to withdraw their deposits, and then SVB had to sell the bonds and book losses. And that's the problem. So one thing led to another, and then there was a run on the bank. Signature Bank, again, is a bank primarily for the law firms, and it's a very different kind of story. It got into trouble, law firm and the real estate firm, and it got into trouble because it allowed cryptocurrencies, crypto assets in the form of deposits. And then the last case you spoke about, UBS taking over Credit Suisse. Credit Suisse was a sort of, I would say, is a cocktail of scandals. Multiple scandals were there. New CEO came, and he had to leave. Another CEO came, and his plan was not approved by the investors. Large investors could not put in more money because there was restrictions from the regulations, and different kind of scandals altogether. And it's historically, it had posted the highest ever loss ever since the Lehman crisis. So you see the character of all these 3 beasts are very different from the Indian banks. So I would still say that we have nothing to be worried about what's happening in the rest of the world. As far as banking system is concerned, our system is fairly resilient. Our financial sector stability is something which we should not lose sleep over it at this point of time.
Are there any pockets in India that we have to watch? Because in your column also, you've talked about cracks appearing in the mortgages and loans for the MSME sector, for instance.
Yes, there is no reason for complacency. There are a little bird tells me that some banks are seeing certain problems in unsecured loan, mortgages, and MSME segment. Why is this? Because primarily the reason is the same, the hike in interest rate. Of course, if you look at the hike in interest rate in US is far higher than in India. India, the policy rate has gone up from 4% last May to 6.5% as we speak. Now, all the loans are linked, part of the loans are linked to external benchmark, which is RBI's policy rate or 364-day treasury bill rate, which means they have all gone up by 250 basis points. So imagine you picked up a home loan at 6.5% or close to 7%. Now you need to pay 9% plus, right? 250 basis point loans have gone up. All the MSME loans are linked to this external benchmark. And the rest of the loan, which is probably 60% of the loans, are linked to the so-called MCLR or the marginal cost-based lending, where also the loan rates have gone up. Now, as a result of that, there are certain segments, they will be in trouble. They will not be able to pay back the loan. Because what's the choice as a borrower? You can, of course, stretch the tenure, but To what extent you can stretch, depending on your age, on your retirement age, and so many other things. There have been reports that home loan can be stretched up to 50 years, the way it has gone up. And you keep on probably servicing only the interest, not the principal. Now, this is the kind of situation. So why did we reach that situation? Of course, one is the interest rate hike. So that's the thing. And second is the risk mispricing by certain banks.
How do you suppose the regulator, the RBI, and the banks are going to react to this?
As far as banks are concerned, they need to retrospect. There needs to be soul searching. Am I capable of doing everything? Am I capable of doing giving every loan, every kind of loan, or should I put in place the right kind of risk management mechanism in place first, and then we'll get into it. So this is a big learning for the banks. I think some of the banks need to take a hard look at the composition of their balance sheet and their credit portfolio. As far as Reserve Bank of India concerned, I have a feeling there will be pressure mounting on RBI to go slow on interest rate hike.
Thank you so much, Tamal. I mean, some very important points you've made there, that it's soul-searching time for the banks. We cannot be complacent. Thank you so much for your insights, and look forward to our next chat. Thank you.
Thank you.
Tamal says there are certain segments that could be in trouble, and pressure will be on RBI to go slow on interest rate hike. Moving on, in our last episode, we asked you, does it make sense to have a fixed rate on home loans now? Majority of our respondents agreed, with 65% saying yes and 35% saying no. Budget 2023 increased tax collection at source for foreign remittances under the Liberalized Remittance Scheme, or the LRS, from 5% to 20%. This will apply to foreign trips, investing overseas, sending money abroad, and other remittances, except for education and medical purposes. And so our question for this week is, are you advancing your LRS payments ahead of July 1? Our polls open on Friday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.